You predicted that NASDAQ had run too far too fast, and that these FANG names are going to collapse, and the growth names and value is going to outperform, and it finally happened. You waited several years for that to happen, but now everything is in a downtrend. So what do you expect to happen next?
Well, we had two things that were at bubble levels. We had growth in tech stocks, and we had bonds, both trading at irrational levels. We had interest rates that made no sense, negative real interest rates. We still have negative real interest rates. So those two things combined with the power of inflation, which you and I have been talking about for at least 18 months, which it continues to be underestimated. So you had those three factors, bubbles and bonds and tech stocks, and unforeseen by the market inflation. That's all coming together to produce some areas of return. I mean, I am feeling everybody's pain, but the fund that I run was flat on the year as of this morning, mostly through commodities. Oil and fertilizer stocks and gold stocks have held up very, very well here. So, look,
is that still the play?
Say it again.
Is that still the playbook?
Absolutely.
Hedge against inflation through commodities?
Absolutely. These names, these operating companies, I wouldn't own the raw materials. I'd own the companies, Mosaic and Apache. Apache's trading at 5 times earnings, maybe 4 times earnings. Mosaic, there's going to be a lot of demand for fertilizer. We've got food shortages in lots of the world. Corn is at $8 a bushel. There's going to be a lot of demand. So that is the way to play this. And then the other way to play it is to keep your bond portfolio short. We still should have the 10-year Treasury way above 288. That's a level that's too low for this inflationary environment. That number is going to go to 4%, in my opinion, certainly this year.
So the flip side of your whole view, Charlie, is if growth really starts to slow down. We got a negative print on GDP. A lot of people think we are going to slow, given all of these headwinds, including the Fed getting aggressive on rising rates. If that were the case, wouldn't you want to be buying bonds and out of that trade? Because we've seen they're pretty extended right now, that sell-off.
Yeah, not at an 8% inflation number. I think we're going to have inflation actually up over the next couple of months. We're not going to see inflation peaking until the summer. And then next year, we're going to see inflation way ahead of the people talking about 2 or 3% next year. So at those levels, you should not be buying bonds. Corporate spreads are still too tight. Those are going to widen out. Keep your durations short. The other things to be doing are, frankly, real assets. Don't be afraid to own a home here. Warren Buffett talks about the value of owning a home, and there are still good value there. Real assets look real good right now.